Hey guys, welcome back to Father and Son Investing. I'm coming to you from inside our barn. We are moving right now, but our house isn't quite ready yet, so we've moved all our stuff into our barn. Today's video is going to be about Treasury bills and bonds. It'll be just a short one because honestly not a whole lot is happening. Just taking a quick peek at what has been happening. One thing I want to point out is that I came really close on my prediction for the 10-year Treasury note. I thought that it would end the month at about 4.35%, and it came in on February 29th right at about 4.339%. So pretty close. Since then, things have been drifting down. That's not unexpected because with each little bit of data that comes in, we've seen the Treasury yield going up or down. So what do I expect to see happening during the month of March? We'll talk about that during this video. I also want to talk about just the massive US Treasury issuance and what's going on with Treasury auctions, because I think that that could affect Treasury yields during the month of March, particularly for the notes, not really the Treasury bills. I think those are just on autopilot until the Fed decides to change rates. I want to show you this graph from the Wall Street Journal in a recent article because this really tells the tale on what is going on with U.S. government debt issuance. Look back here in 2015, running right around $7 trillion or so. And then look at how it exploded up in 2020. Obviously, there was a pandemic going on there, and the government certainly was using their debt issuance to try to keep the economy going and keep people able to pay their bills. But then in 2023, when we're not in a recession, when GDP is running at a fantastic rate, the government, however, is borrowing even more money than they did during the pandemic, and that is a problem. From this same article in the Wall Street Journal, let's just take a peek at how the U.S. debt held by the public is expected to increase over the next few years. If you'll notice here, by about 2033, 2034 or so, we're going to be approaching $50 trillion in debt held by the public, while meanwhile we're just under $30 trillion. So this is going to go up significantly in just the next 10 years. Meanwhile, the percentage of the interest on our debt as compared to GDP, you can see how this in darker blue has just increased significantly compared to the primary deficit. The amount of interest that we're paying as a percentage of GDP really is outrageous. And this, of course, you have heard probably many times in the news where interest on the debt now will be exceeding that of defense. It actually exceeds Medicaid as well. The two things that are actually more than the interest on the debt, of course, are Medicare and Social Security. Now, I show you all of this just to give you an idea of the magnitude of the U.S. debt issuance, because I want to move on now to the Treasury auctions and try to tie these together. There have been two 5-year Treasury auctions in a row now that really have come in not very well. The one here on January 24th, 2024, the headline 5-year Treasury auction was a dud. The primary dealers, that's a group of bankers and other financial institutions that have to absorb the Treasury auction when not enough of it is sold. They took up 20.4% of the supply, and that was the most since September 2022. That's indicating that demand is weak. Let's fast forward to the most recent auction near the end of February. Here's the headline from MarketWatch: Treasury's record size, keep that in mind, record size, $64 billion sale of 5-year notes gets so-so demand, testing appetite for more supply. Testing appetite for more supply. Why? Because as we look further down in the article, future 5-year auctions are about to get bigger, growing to $67 billion in March, so that'll be another record auction, and estimated $70 billion in the second quarter. If we're having difficulty with 5-year auctions at this auction size, what's going to be like when we start increasing that even more? So this is something to keep an eye on. We have some auctions coming up in the next week. On March 11th, there will be a 3-year auction. On March 12th, we'll have the 10-year auction. And on March 13th, we're going to have the 30-year Treasury bond auction. So we want to keep an eye on these to see what the demand looks like. If there is weak demand in any of these, this could cause a spike in the bond yields for the 3-year, the 9-year, and obviously the 30-year, but also potentially the 10-year Treasury note. So keep an eye on these auctions. I want to point out one other thing for what I see as my game plan for the month of March, and that is the monetary policy report that just came out. You may be aware that Chairman Powell was speaking to Congress yesterday, March 6th. Each 6 months, he's required to do that, and every 6 months, the Fed is required to give a report to Congress, and this is their report, this monetary policy report for March 1, 2024. It's an interesting read. A lot of it just sums up what has already been said previously by the Fed, but I want to point out one thing. Here on page 24 of this report, there's an interesting graph, and this shows the difference in what the expected Fed funds rate has been, or the change in the Fed funds rate compared to June of last year and now February 27 of this year. And let's look at two things here. Notice how the slope of the line has changed, meaning that the expected Fed funds rate decreases have gone up, essentially, meaning that the Fed will not be decreasing as much. And notice how it has shifted such that the time frame is going to be shifted further out in terms of when cuts may happen. So keep this in mind. This is from the Fed document, this annual 6-month report, and we may not see much of this, but this gives you an idea of what the market implied Fed funds rate path is. All right, let's just talk about what I think my game plan is for the month of March when it comes to Treasury, bills, notes, and bonds. When we're thinking about bills, really, I think the 6-month is looking very attractive, this 5.308%, not that much off of what the 1-month bill is, and potentially if the Fed should cut rates anywhere in there, you're going to get just a little bit more yield. So that one actually looks quite attractive to me. Otherwise, the 3-month bill also looks quite attractive. In fact, it's got a better yield than the 1-month bill. So either one of those look really attractive to me. When it comes to Treasury bills, notes, or bonds, honestly, I'm expecting at some point that the 10-year Treasury note is going to start climbing. I don't know exactly when that will be, maybe the end of the year, perhaps into 2025. But I think because of all this government debt being issued, that people are going to start demanding a premium. In fact, I've been reading articles about bond vigilantes and really how they can affect that yield on the Treasury notes as well. That may come up in a future video. So what do I like? Well, I'm looking at these shorter term ones, the 2-year and the 3-year note, just because, again, I expect, because of all this government debt, that long-term Treasury debt yields should be rising. That's all I have for you today. I know it was kind of short and sweet, much different than the 20-minute video that I did a couple of months ago. Please give us a thumbs up if any of this was useful for you, and as always, until next time, enjoy your investing.